Hey guys, it's Sasha. Last night, Tesla published their Q3 results, and this was one of the most bizarre quarterly earnings we have seen because I saw an absolutely epic set of numbers that made me extremely excited to be a Tesla shareholder. But a bunch of mentally challenged raccoons also saw the exact same results, but because they can't do basic reading comprehension or math, determined that Tesla is doomed, the growth story is over and it's time to sell the stock, and they quickly went and did exactly that. They went and sold the stock. So Tesla share price is over 8% down so far this morning as I'm recording this video. The strategy of buy high, sell low just keeps on giving. I could not be happier because here we have a company that is absolutely killing it, posting monstrous earnings after monstrous earnings, and the stock just keeps on going down. And if you don't understand why this is amazing, you probably shouldn't be investing. If this is the kind of thing that makes you upset or concerned, maybe think of a better way to spend your money. Maybe think of a better thing to get interested in. Investing might not be for you. It sounds like we are going to have a quarter, maybe even longer, where you can go and buy Tesla stock selling at a huge discount for seemingly no reason whatsoever, which to me seems really odd. But here we are in an investing world full of headless chickens running around. So let me walk you through these results. I'm not going to point out the obvious, but I will point out how investors have completely misunderstood the numbers in somewhat of a spectacular way. First up, Tesla posted record revenues of $21.45 billion, but this apparently fell short of the analyst targets of $21.9 to $22 billion. And the obvious question is, which part of their ass did they produce the target from in the first place that Tesla failed to hit? You can see that in Q4 and Q1, Tesla delivered 308 and 310,000 cars, roughly. And in Q3, they delivered 343,830 cars. We've known these numbers for over 2 weeks before the results were published. And in Q1, Model S and Model X made up 14.7 thousand cars out of the 310,000, 4.7% of the total. In Q2, because of the Shanghai shutdowns, Model S and X made up 6.3% of the total. And in Q3, the 18,672 cars made up 5.4% of the total. So slightly closer to Q1, about 40% from Q1 to Q2 on the distribution. So here is some basic maths. First, work out the automotive revenue in Q1 and Q2 without regulatory credits. 16.182 billion in Q1 and 14.258 billion in Q2. Then divide those revenues by the number of cars sold, aka delivered. Q1 made $52.19 thousand per car, and in Q2, Tesla made $58.75 thousand per car. 40% of the way from 52.19 to 58.75 is $54.81 thousand per car. Multiply by 343,830 cars delivered and you get $18.85 billion. Then remember that the dollar strengthened by about 6% versus most currencies on average between Q2 and Q3, and 60 to 65% of Teslas being sold this year are sold outside the United States, so there's roughly a 4% headwind from foreign exchange rates. So take 4% off the $18.85 billion and you get $18.1 billion as a rough guesstimate of Q3 automotive revenues, what they roughly should be. And what did Tesla post? $18.692 billion minus the $286 million in regulatory credits, that's $18.4 billion. Pretty much bang on. Energy posted record revenues of $1.117 billion, above where it has been for some time, and services and other also posted record revenues of $1.645 billion in Q3. So the simple fact is, the revenue target that Tesla failed to hit, that the analysts predicted, somehow didn't make any sense in the first place. But let me dive a bit deeper into the numbers because I saw some really interesting things in these results. First, the automotive gross margin stayed flat at 27.9%, and some people pointed at it and said it's the same as back in Q2 when the Shanghai factory was shut down, so it sounds like the margins are collapsing, it's the end of the world, sell the stock now, get rid of it. Well, in Q2, Tesla produced 258.6 thousand cars and delivered 254.7 thousand cars, a difference of only 3.9 thousand cars. In Q3, Tesla delivered 22,000 cars less than they produced. When you're looking at a gross margin, it is the difference between the revenues that you generate from selling the goods, selling the cars, which come from cars sold, and the cost of manufacturing and delivering cars. So in Q3, we have a whole load of extra cost associated with manufacturing cars that weren't sold within the quarter. In Q2, Tesla made 1.6% more cars than they sold. And in Q3, they made 6.4% more cars than they sold. That difference alone would have dropped the automotive gross margin from 27.9% to 21.6% if everything else stayed constant. So to pull off a 27.9% margin despite having the deficit in deliveries, despite having some of the other headwinds on FX, etc., is exceptional. The fact that Berlin and Austin are ramping is helping the margins improve slowly, and Zach Kirkhorn, the Tesla CFO, said on the call that without taking Berlin and Austin into account, the margin looks more like 30%. So for me, the revenue is a beat. Margin is a beat when you understand the circumstances. The energy sector posted a gross profit for the second quarter in a row, and this is very important because my model assumes the energy segment to become a very substantial part of Tesla's total business over the next 10 years. Elon Musk himself has been saying this over and over for a long time. You can see that energy made $1.117 billion in revenue, and the cost of revenues was $1.013 billion, so a gross profit of $104 million. Very, very encouraging early signs. On the call, Elon Musk said that Tesla is looking to build out a 1,000 gigawatt-hour capacity on battery production in the United States. Now, just to put it into perspective, if you assume an average car to have, say, an 80 kilowatt-hour battery, including the Cybertruck and the Semi, which is why it may be a bit higher than what people think, that would be enough for making 12.5 million cars a year using just the US-made battery packs. Or you could make less cars in the United States and put the spare battery capacity into mega packs, which is where it's actually going to go for the energy part of the business. In other news, Tesla made $3.3 billion in free cash flow and used $900 million of that to clear long-term debt, which now sits at just about $2 billion. And the cash pile has now grown to $21.1 billion, which is so healthy that a bunch of investors have spent the last 2 months asking whether Tesla is going to do share buybacks. Elon said on the call that maybe Tesla will do $5 to $10 billion worth of share buybacks next year because everyone's been asking on Twitter. I am not sure why everybody is so ridiculously excited about these share buybacks. They make almost no difference whatsoever. It's like going to a Michelin-starred restaurant and getting excited about the napkin. If you go and look at the numbers, if you have $10 billion worth of shares being bought as buybacks, even if the share price stays low as it is right now for the next year, that's only like 1.4% of Tesla's total market cap. Elon Musk sold $7 billion worth of Tesla stock back in August. $10 billion spread over a year doesn't really mean very much at all when Tesla stock jumps up and down by 5% or 8% on any given day. You can see that Elon sold another $8.5 billion worth of Tesla stock in April and another $5.6 billion back in November after you ran that famous poll on Twitter on whether you should sell some stock or not. I will put a link to this data in the description. You can sign up completely for free with Simply Wall Street to get this data and a whole lot more. Simply Wall Street, by the way, thank you so much for being the sponsors of this video. If you want to get a breakdown of everything you need to know about the company in a super easy to look at graphical way, you can go and sign up to Simply Wall Street to look at stocks. Here you can see that Wall Street thinks that Tesla is overvalued because Wall Street is generally incapable of valuing growth stocks, but you can also see a history of Tesla's financial performance, which, surprisingly looks really good. A breakdown of their financial health, which, surprise, surprise, is also looking great when you have a mountain of cash and next to no debt. And even a who's who of the company along with their official job titles. Here we have Elon Musk, the techno king of Tesla, and Zach Kirkhorn, the master of coin. Use my link in the description to get yourself a completely free account with Simply Wall Street. made, and if you like it a lot, like I do, and want access to more features and tools, the first 100 people to sign up using my link will get a 40% discount on the paid plans, so make sure you go and check them out. The link is in the description and in the pinned comment. So, one really interesting thing that Elon Musk confirmed on the earnings call is that Tesla's product team is working on the next generation car platform for a smaller, cheaper car that would be half as expensive to manufacture as the Model 3 and Model Y. If only there was somebody who's been saying that this is exactly what's going to happen for the last year or two and had this exact model baked into their valuation, arriving somewhere at the back end of 2025 going into 2026. The good news is that Tesla confirmed this for the very first time after publicly saying they are not working on the smaller car at the shareholder meeting last year. So I guess we will get an update maybe at some point next year, as and when the initial design and engineering work is far enough along the way to show off a prototype like what happened with all the other models. And on the earnings call last night as well, Elon Musk said that Q4 production might run slightly below the 50% target, and again a bunch of deranged chipmunks heard that Elon said the rate is going to be dropping below 50% and went berserk. Oh my god, Tesla growth is stalling, time to sell stock. Hey, sell your stock, I'm going to sell my stock, let's get rid of every share. But the thing is, just go and look at the production numbers and do some basic mathematics. In Q4 last year, Tesla pulled off an insane production quarter, making 305,840 cars, a huge jump on the previous quarter alone, a mammoth quarter, and Q4 this year is going to compare to Q4 last year. So Elon is saying what is blatantly obvious. Look at the current production run rates. Shanghai made 83,000 cars in September. So let's say the average 83,000 cars per month in Q4, for example, that's 249,000 cars. Fremont is running at an annual run rate of around 600,000 cars, which is about 150,000 cars a quarter. Berlin just broke the 2,000 cars a week production rate. So let's say they average 2,500 cars a week, for example, for the 13 weeks in Q4, including the holiday season. That's another 32,000 cars. Texas is on for a bit less, maybe 20 to 25,000 cars. So if everything goes to plan, we are maybe looking at 451,000 cars produced in Q4 without any unforeseen issues like more shutdowns in China. But even 451,000 cars, which would be insane. Just think about that number compared to what we saw this quarter. That would not quite hit the 50% long-term target. It would only be 47% up on Q4 last year. But remember that the 50% target is not for every single quarter. It is the long-term average. Production in Q1 this year did not grow from Q4. Production in Q2 fell because of the shutdowns. This quarter, Tesla is above the 50% mark. And in Q1 and Q2 next year, Berlin and Austin are going to continue ramping towards proper scale production. So we should be seeing over 500,000 cars a quarter being made in the first half of next year. Q2 next year may well hit over 100% year-on-year growth. I actually hoped that Elon Musk would maybe announce some new factory locations on this earnings call. Unfortunately, we didn't hear anything. Last year, Tesla promised to announce new factory sites in the second half of this year, and this was the last major event at which it would have made sense to do it, but we got nothing. No updates on new phases being constructed in Shanghai, Berlin, or Texas. No updates on any new locations, and given it takes over 2 years from announcing a new factory site to it being operational, Tesla will really need to get cracking on that factory construction sooner rather than later if they want to sustain that 50% year-on-year growth that they are looking at this year and next year into 2024, 2025 and beyond. Now, on the call last night, Elon twice made the point that he expects Tesla to have a bigger market cap than Apple and Saudi Aramco combined in the future, which I do think is very possible given the current state of Apple and the long-term outlook for oil companies. I'm not sure if talking about company valuation in that way is the smartest thing that Elon can be doing, maybe focusing a bit more on the execution and some of the details that were missing from the conversation last night. My valuation, though, is not too far off. I will share the details of an updated valuation model in a separate video coming up soon, so make sure you look out for that as and when that comes out. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching, I really appreciate it, and as always, I'll see you guys later.